Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, January 26, 2022, and I am pre-recording this Trading Places Live for just a little bit later this morning. Currently, futures are pointing up. We've got Dow futures up 43, S&P 500 futures up 19, NASDAQ futures up 117. So on a relative basis, we got leadership from the NASDAQ today, certainly partly due to Tesla, which reported record revenues and beat on their bottom line. Margins contracting, though, so got a little bit of a conflict there. But overall, market liked what it heard. Tesla up this morning, and that is certainly having a nice impact on the NASDAQ. Crude oil, 81.18 per barrel. That's up $1, so a little more than 1.25%. And the U.S. 10-year Treasury yield up 2 basis points this morning, 3.48%. We've got a slew of economic reports. We'll go over those in just a minute. Before we get started, though, I do want to go through today's agenda. So let's start off with what we'll start off with is the daily market recap, then talking technically. Want to go through industry groups. I always find it really important just to see where the money is rotating to in terms of trying to find good, solid trades. And so we'll take a look at that, go through, look at some of the rotation there. First, I'm going to take you over to earningsbeats.com. For those of you that are new, if you go over to earningsbeats.com, scroll down, free newsletter. Name and email address, all it takes. Hit that subscribe button. There's no credit card required. You can unsubscribe at any time. This is a 3 times a week newsletter, Monday, Wednesday, Friday, that I like to publish about an hour before the market opens. It's a very quick read, normally just a couple paragraphs and a chart. If you're looking for education, looking for tips, how to improve your trading, those types of things, I would highly recommend you check this out. Anyone who is on our Earnings Beats Digest newsletter gets invitations to any free events that we do. So that's another side benefit there as well. All right, earlier I mentioned talking about industry groups to try and find some solid trades. Well, later today, 7 o'clock this evening, we are going to have a planning session among annual members at Earnings Beats. And we're going to talk a little bit about how to plan for the trading day, some of the things I look at before the day begins, and honestly, just look over the market and just get a better feel for the different time frames. Do we have any negative divergences anywhere? With this rally, what's the 60-minute look like? All of those things I believe help you formulate a smart trading strategy for the day. So that'll all kick off tonight. Tomorrow morning, we will be having a room open starting, this says 8:45, might get it started a little earlier, maybe 8:30, but we'll let the members know when we send out the instructions. But we're going to talk about the pre-market, talk about economic reports, go over a lot of earnings reports that have come out, and just talk about the strategy for the day as far as which scans we want to run, the different types of scans against which chart list. We do a ton of research at Earnings Beats, and this is going to be an event where I can show you how I use all of the research that we do to come up with what I think are solid trading candidates for the day. Anyhow, all that is going to take place later this evening, planning session, and then starting tomorrow morning, it'll be an all-day live trading room just to go over what I'm seeing on the charts. I'll walk you through everything that I look at throughout the trading day. If you want to become part of that, or you want to be part of that, start your no-cost trial. That's number one. You'll get 30 days free. But if you want to be in this event, you do need to be an annual member. So you can check out the service, take a look at everything we have to offer, and then make a decision. If you do decide to join annual, you still get the rest of your 30-day free trial. Just want to make sure I point that out. All right, let's move on to the market. So on Wednesday, we saw the market gap down significantly at the open. It was kind of a weird day because Microsoft in the after hours back on Tuesday evening, they initially were up $10. Stock looked like it was going to lead the NASDAQ higher, probably the S&P as well. I know the NASDAQ was up, I don't know, probably 0.5% after the market had closed on Tuesday, just in the after hours trading. The QQQ was up about 1.5%, or excuse me, about 0.5%. And then the Microsoft conference call started. We saw things turn around before the end of after hours was over. Before that session had ended, Microsoft was then down, I want to say like $7, and ended up opening down, I believe, well, quickly was down about $9 or $10 in the morning yesterday. We'll pull that chart up in just a few minutes. But Microsoft got things off to a rough start. The market traded down. The good news, though, if you look at the S&P 500, we went right down to the 20 and the 50-day moving average, and we shot right back up, finishing back up above 4,000, only down a fraction, down less than 1 point on the day after being down quite a bit in the morning hours. So it was a nice steady move the rest of the day. And folks, this is what I've been talking about, honestly, for the last 6 months. We went through a period of distribution back through May of 2022, where we were seeing selling all day long. Didn't matter. We saw gap downs. We saw morning selling. We saw afternoon selling. We just saw plain selling. Since May, when we went to that June low, when I called the initial market bottom, since that time, we have seen a lot of gap downs, and we've seen a lot of what I call amateur hour selling, which is the first half hour of the day, even maybe first hour or so. But after that, we've seen accumulation. I've been talking about this now for 6 months. There has been a ton of accumulation in the market. I broke down every single trading day by gap down, 10 a.m., 11 a.m., 2 p.m., and 4 p.m. Since June, you would have made a fortune if you had just bought the Qs or the spiders at 11 in the morning. Probably, I'd have to go back and look, but probably as of 10 in the morning. If you just ignored gap, in other words, get out of the market 4 o'clock. You don't want to be in the market and getting hammered with these gap downs or the first half hour of trading. Beyond that, if you just looked at the action after 10 o'clock in the morning, since June, we've been in a bull market. I mean, say what you want. I mean, I know what the numbers are. I've done the research. There has been a lot of manipulation in this market. Wall Street, once again, taking advantage, all the big firms taking advantage of all the little guys. Everybody's still believing we're in a bear market. Probably not going to be believing that much longer, in my opinion. Stock market wants to go higher. It's been we've seen accumulation throughout the day. Look at the AD lines. As I've mentioned multiple times over the last several months, the AD lines back during the secular bear market fell apart. They absolutely fell apart. These don't look bad to me. Just saying. All-time highs on the Dow, S&P, NASDAQ, mid-cap, small-cap, pick one. Look at all the sectors down here. Financials taking off. Discretionary even finally coming to life. Communication services, they were dead in the water last year. This is the new normal for communication services. They're trending higher. Utilities, not so much. Defensive group. Industrials rallying, the AD line. I don't know how anyone can still cling to the bear market theory, but again, this is just my opinion. Been saying it for a long time, though, that we have gone through a period of a bottoming process, call it whatever you want. But I believe by the end of this year, possibly into the early part of next year, stock market's going to be an all-time high. We'll see. As far as sectors go, it was really mixed yesterday. Financials finished strong, up more than 0.75%. Discretionary up 0.5%. Communication services up 0.35%. Utilities, though, lost 1.35%. Industrials lost a little bit more than 0.5%. So it wasn't everything going up yesterday, but we did see consistent rotation into some of the aggressive areas, which I find to be very bullish. 10-year Treasury yield. Well, as I mentioned, let me give you that pre-market. Right now, 10-year Treasury yield up 2.5 basis points. So we're up at about 3.49%. So I would say still in this overall short-term downtrend. intermediate term downtrend, longer term uptrend. The longer term uptrend stays intact as long as you put in higher highs, higher lows, higher highs. I mean, we'd have to get back down below 250 or so before the longer term technically would be ended. I think we're going to go back down there. I think we could get back down to 2.25%. Don't know that that's happening this year, but I wouldn't be surprised if we're back below 3, maybe 275 to 3. But we got to take out 250 or so, 255, in order to reverse the longer term trend here. Let me go through some of those economic reports that you'll be hearing. Actually, by the time you get this recording, you will have already heard it. But there are a lot of economic reports coming out. December durable goods will be out. The estimate is for a rise 2.8%. November actually fell 2.1%, and durable goods tends to be extremely volatile. I think the only way you really should look at durable goods is probably to smooth it out over 3 to 6 months and just look at that average, because it does go up and down pretty violently sometimes. If we strip out the transports, then December durable goods was actually down 0.2%, or expected to be down 0.2%. November rose 0.2%. So you can see that volatility is coming from the transport area. Q4 GDP expected to come in at 2.7%. The Q3 final was 3.2%. So we are expecting it to come back a little bit. But if we were to show anything negative or close to negative, it would be a big shock this morning. We'll see what happens there. Initial jobless claims, remember last week, came in way below expectations. So big surprise down at 190,000. We are expecting that to jump back up this morning to 202,000. December wholesale inventories expected to rise 0.5%. November rose 1%. Like to see those inventory numbers come down. December new home sales, 614,000 expected. November was 640,000 units. So we are expecting a decline there. The new home sales will be out at 10 a.m. All the others will be out pre-market. So by the time you're listening to this, you should see everything except those new home sales, unless you're listening after 10 o'clock. All right. Let's keep moving on here. Let's talk a little bit about the S&P 500. So here was that move down I talked about yesterday. And you can see now 4 days in a row, hollow candles. We gapped down. This would have been last Friday. We gapped down, came back up, finished nice and strong. Then on Monday, pretty much open flat, strong. Then we gapped down on Tuesday, but finished above the open. Yesterday, gapped down, traded pretty low in the morning, and then came rallying back. Really nice action there. NASDAQ 100, maybe even better. Didn't even go down to the 20 and the 50 and turned around and came right back up again. Very, very strong. We got some overhead resistance we need to take out. We still got the trend lines to take out. I would say on the NASDAQ 100, watch 12,200. If we get through 12,200, I think the downtrend is ended. Honestly, that's what I'm looking for confirmation that the bottom is in, that the cyclical bear market bottom in October is confirmed. I believe that happens if we break out above 12.2 on the NASDAQ, and I'm going to say 41.10 on the S&P 500. Now, going back to the S&P, I wanted to show you that intraday move in the morning. This was the morning move, but look at what happened. Buyers all day long. What happened the day before? We were weak. Buyers, certainly not as much, but we went higher the rest of the day. Back on Monday, you can see buying throughout much of the day, had some profit taking 2 to 3, and then saw buying resume again end of the day. Go back to last Friday, buying throughout the day. This is accumulation. So you get the scares, the gap downs, the morning weakness, amateur hour, and then the buying kicks in. We've honestly seen a lot of this since June. All you have to do is open your eyes and look at the charts. It's there. Been talking about it for a long time. Anyhow, I want to show Microsoft so you can see what Microsoft did in the morning. Look at this, gap down, 10 o'clock, there's your first half hour. Everybody that wanted to panic was out, and then the pros came in and were buying all day long. The thing with Wall Street firms is they're not looking, a lot of traders, you're looking at what you're doing today. Wall Street firms, first of all, they're trading millions and millions of shares. They can't just go jump in today. They have to build positions over time. So while the market is going down and gapping down throughout all of last year, Wall Street was accumulating throughout the trading day. They had market makers. Market makers have institutional clients. Market makers will be buying for pension funds and for other large buyers that just can't put 1 million shares market order in. You just can't do that. They accumulate. And then many times after market makers have accumulated from the gap downs and from the morning weakness, then they will transfer shares to these bigger firms. A lot of times it's in the dark pools that you've heard about, which I'm okay with because I think volume sometimes gets double counted. I mean, if market makers, if all they're trying to do is accumulate shares from you and me so that they can turn them over to an institutional client, it really should just be one transaction. So I like the big moves between market makers and the institutional clients off of the books of the market so that we can just see the real volume and not have things double counted. Just again, my opinion. Let's move on. So I wanted to talk a little bit about the sectors and the industry groups, especially the industry groups. But I'll start off just by going through the sectors real quick. Technology in January. Listen, if this rolls back over, I'll be one of the first to tell you. But in January, when we have good Januaries, we tend to have good rest of the year. And this January is being led by technology to the upside. This rally is being led by consumer discretionary to the upside. Now, it's obviously been in a long-term downtrend. I'm not saying consumer discretionary is healthy. I'm just telling you what's leading this rally in January, and it's good. Look at communication services. It was a ski slope all the way until October, end of October. Got a little bit of strength into the end of the year, but look at what's leading again in January. These are the three most aggressive groups. And folks, they are pounding to the upside. This doesn't mean they're going up. This means they're going up faster than the S&P. The S&P is up nearly 5%. These are up much more than that. Now, industrials, some of that money's coming out of the industrials. Hey, not everything can lead the S&P 500. When you've got leadership like we saw in those three aggressive groups, it's going to come out of most of the other areas of the market. Financials went down. They're starting to come back up again, but they're down for the year. Healthcare getting hit. Remember, the defensive groups, healthcare. Staples, defensive group, getting hit. Real estate, not bad, but real estate was actually hit in the second half of last year. But it went up early, starting to roll back over again. Utilities, down. And energy and materials, I kind of view those as neutral groups just because they can kind of do things. They can lead in a bear market. They can lead in a bull market. Usually with the aggressive and the defensive groups, not so much. Materials still doing pretty well. Went up early in January, come back down on a relative basis there. But this is all part of the rotation that I'm talking about. It's not just rotation intraday looking from 10 o'clock to 4 o'clock. It's not just the fact that there are buyers sending the QQQ and the spider up during the day. It's also where the money is coming from. Here in January, it is strictly rotation into the key aggressive groups. Maybe it's a relative dead cat bounce because these groups were so weak for so long. That's possible. The only way we're going to know is by continuing to follow it. So let's continue to follow it and see. And if it weren't for other signals that I'd seen in the market for the last 6 months, I'd probably maybe take all of this with a grain of salt. But I have been talking about other signals all along. I mean, sentiment has completely reset. If you don't believe sentiment has reset, go back and look at some of the comments that I've got on my YouTube videos from when I've called bottoms. Back at the beginning of the year, when I said there was a bull market, I was getting criticized because how can you call a bull market when the market is still near an all-time high? It's not even down 20%. Well, if you can call it ahead of time, it saves you a lot of money. Just like if you can call the bottoms ahead of time, it can make you a lot of money. There are signals. If you research, which is pretty much all I do, if you research the market, there are signals. I've studied every bear market since 1950. There are signals that will tell you when the tide is changing, when the market is going through a character change. It's been happening for the last 6 or 7 months. We're now about to see why Wall Street was accumulating. But that'll be a story show for another day. All right, so let's take a look at the industry groups. So what would I do looking at these industry groups? So I've got this set up, 104 industry groups on this chart list. This is part of the research we do. And we put all of our stuff on the StockCharts platform, all the chart lists. So all of our research is organized into chart lists. So this particular chart list is our industry group relative strength chart list, 104 industry groups, all in here relative to the S&P 500. So when you're going through and you're looking at these, just keep in mind that we've got them set up so that all of these that start with 1, these are all technology, XLK. And then I've got them further broken down 1 through 8 industry groups within technology. And then there's the industry groups, their ticker relative to the S&P 500. I do this for all 11 sectors. So all these 2s are the XLY set up from 001 down to 020, which is the 20 industry groups within the consumer discretionary group, and so forth and so on, all the way down through energy materials to wrap things up. So I got 11 sectors and all the industry groups. The beauty of this, now I can sit here and say, well, okay, there's the first one. This one looks like it's starting to roll back over a little bit. Here's the second one. Wow, look at semiconductors. All of a sudden, one of the strongest groups. A lot of folks were saying, well, how can the market go higher if the semis aren't participating? Well, you can throw that argument out the window because semiconductors now are leading to the upside. Very exciting. But rather than go through 104 like this, if you use the view all and hit summary, this will tell you yesterday the worst performing industry group. So railroads was the worst group yesterday. Coal was next. Then we had internet stocks. Then we had the conventional electricity. Then we had renewable energy and so forth right down the line. If you wanted to see the top performers, you would just click on the percentage change column and pull that up. And so you got fixed line communications, you got non-ferrous metals, publishing, and then here's your gold. Here's your miners coming in here. Had a pretty nice day yesterday. But this is just one day. Is this a trend or is it just a day? To me, it's just a day. So, I mean, if you want to see what's been hot over the last week, do a 1 week. Autos have been the hottest. Then you got brewers. I don't know, maybe you've noticed this, maybe you haven't. But this is a quick way of finding out without ever going and looking at any charts. Just quick little, glance at the 1 week. Now, I prefer looking at either the 1 month or the 3 month. So this over the last month, now keep in mind, we've been really strong in what? Technology, discretionary, and communication services. So over the last month, what I should see are a lot of those 3 groups here. And notice discretionary, communication services, discretionary, technology, discretionary, and then get into some others. But you see a lot of discretionary groups. And yet everybody's talking about the recession. Oh, well, yeah, the markets, wait until the recession hits. Folks, the stock market doesn't wait until a recession hits to start selling off. The market looks ahead. The market priced all of this that we're seeing today in 6 months ago. The stock market now is going to break out because it is pricing in lower interest rates, declining inflation, and the end of the recession. That's how the market works. Anyway, so I would look at this and say, okay, these are some of the groups that I obviously want to be interested in, or I should be at least taking a look at, right? So how about travel and tourism? Actually, the first one of them is the semis. I already mentioned them. I know I have them up on this list. So let's take a look. Semis haven't gotten the breakout. It's like we're right up against it. But October, we were down under 5,000. We are now at 6751. We've gone up almost 2,000 points now on semiconductors, which is more than 40% in 3 months. You can't ignore that. Now let's look at the travel and tourism. This one got some overhead resistance up at about 650. I'd like to see that break out. But look at the relative strength. Relative strength now looks like it's at the highest level that it's been since back in early May. And look at all these hollow candles. Very little selling intraday. We're just going up, up, up for the most part. You could take a look at the 60-minute or hourly charts, and you could just see this has just been a steady push higher in travel and tourism. That makes a lot of sense with a recession coming, right? Everybody wants to travel and spend a lot of money traveling when recession's going to hit. There's some sarcasm in there. Just think, why are all these discretionary areas leading? Discretionary stocks would be the ones to get hit the hardest if a recession was coming. And guess what? They did. It was back in 2022 as the market was forecasting weakness ahead. Now the market is forecasting strength down the road. That's what the charts are saying. You can listen to CNBC all you want. The charts are saying things are going to be a lot better down the road, and the market doesn't wait for the good news to start in order for the big firms to start buying. They're buying your shares, anyone else's shares that want to sell into these gaps and into the morning weakness. They're buying. All right. Well, I've got to wrap this thing up. I know I didn't get to the earnings and the 3 you must see, but I am running late here. I want to make sure that I get cut off here on time. So do want to thank everybody for stopping by. Come join us at Earnings Beats and come to the live trading room tomorrow. I think you'll really like it, get a sense for what we do. I think it'll help in your trading. Anyhow, that's it for me. Appreciate it. Have a great rest of your week and weekend, and I'll see you next week. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.